Hello, friends. Welcome to this Dirty Economics live coverage of the U.S. non-farm payrolls. And what we are going to do is that in the first 15 minutes in the run up to the non-farm payrolls release, we would look at the expectations and the way market is positioned for the event, and post release we would just look at some of the technical charts of the major markets and try to anticipate the future moves. So as the topic goes, this is U.S. non-farm payrolls impact on FX and gold, presented by Dirty Economics. And in the preview, this is the economic calendar. The change in non-farm payrolls August. Markets expect the figure around 180,000, and the previous month's figure stands at 255K. So compared to the previous figure, this is a significant downward revision. But uh, 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 as the experts say, market experts say, anywhere around 180K and 200 or 200K would be a fine figure. And you have the unemployment rate, which is seen falling further to 4.8% from the previous figure of 4.9%. And the most important figure, in my opinion, that is the average hourly earnings. The month-on-month change is seen at 0.2% compared to 0.3%. So, looking at the calendar, the expectations slightly tilt on the negative side, mainly because the hourly earnings are seen, the growth in the hourly earnings is seen slowing down. What there is every month before the non-farm payrolls, there is so much of speculation that what the number would be and how markets would react, whether 200K would be a good number, or whether 250K would be a good number, whether the dollar would rally or not, how would the Fed fund futures react. And so what we have done here is that we have included a video from Tip TV. They had a expert, London City expert, Mark Ostwal, strategist at ADM Investor Services International, and he talked about the non-farm payrolls, and he pretty much answered every query that a trader or investor could have heading into the non-farm payrolls release. The key statement. The key comment from Mark was, the Fed rate hike with respect to Fed rate rise was that market skepticism isn't surprising. What he wants to say is that markets simply do not believe every time Fed officials come on the wire and say that rates could be hiked once or twice this year. So markets do not really take Fed seriously, and that isn't surprising. But this is because every time Fed officials came out hawkish, eventually they backed off. So they talk hawkish, but they do not walk hawkish. And that is the reason markets do not buy the hawkish talk anymore. So the skepticism isn't surprising, but that means we could be in for a shock. In for a shock means if suddenly the Fed decides to ignore the market expectations and go ahead with the rate hike, given that it risks falling behind the curve. Many believe that it is already way behind the curve. So in case the Fed decides to flex its muscles, irrespective of the market expectations, then that could be a shock. So coming to the main points, that Mark discussed on the Tip TV show today, was August payroll figure is unreliable due to problems with data collection. If you are a trader or investor, and if you do follow a lot of financial websites, then you must have read a couple of articles saying that August payrolls are highly unreliable. Over the last 5 years or so, as far as I can remember, over the last 5 years or so, each time the August payrolls number missed estimates by a wide margin, only to be revised higher in the subsequent months. So that takes the shine away from the NFP number today. And it's pretty much then it comes down to the third point, that is Fed would be more focused on average hourly earning. And the pace of the wage growth has been respectable, but Fed would like to see more wage price inflation. And Overall, the conclusion is that uh, the NFP figure anywhere around 180K would be good. 180K, 200K would be good, and uh, the main focus would be on the average hourly earnings. We can have a combination of a weaker than expected NFP figure and strong wage growth figures. And in my opinion, in this case, the dollar would rally because the odds are high that the weaker NFP figure would be revised higher next month. So the main event for the day, main data for the day is average hourly earnings. As we can see, the third last point, non-farm payrolls figure, if it's anything under 150, the September rate hike odds would drop. However, I would like to add here is that if the wage growth figures are very strong, then an NFP figure below 150K wouldn't matter much. And anything around 200 is pretty compelling as far as rate hike bets are concerned, and that would cement expectations of a September rate hike. The interesting point that Mark makes here is that Fed would raise rates only if it sees Mark only if it sees the September rate hike probability above 50%, at least 50%. Ideally, it should be 60%, which would ensure that markets their rate hike would not shock the financial markets or trigger instability. So unless and until we do not see or the Fed does not see the rate hike probability above 50%, it won't move. And this is applicable for September, December, or any of the month for that matter. And that forces us to think, and that would also force you to think whether Fed is data dependent or it's at the mercy of the financial markets. So you could catch the daily tip TV shows on their website, which is, and they also play it live on YouTube, and it's so the US Open show is currently on, and you could check the old shows or the segments over here. We usually the London Open comes around, and you could find a number of videos over here. So let's proceed to look at some of the markets now. We are just the NFP is just 5 minutes away now exactly, and let's just have a look at some of the major markets. The first one obviously would be British pound, and as you can see, I have a Fibonacci retracement setup over here. The key resistance is 1.3315, which is the 23.6% Fibonacci retracement level of the pre-Brexit high, that is 1.5019, a Brexit day high for that matter, and post-Brexit low, that is 1.2789. And unless and until we do not see a day and close above the same, the upticks are to be viewed with skepticism. Right now, it's trading around 1.3280, and it clocked a high of 1.3317 yesterday and retreated. And if in case we have a horrible wage growth figure, along with a 180K or 200K NFP, even a 180 or 200K NFP won't be able to overshadow a horribly weak wage growth number. And in that case, I guess pound could go higher to retest 1.3371, which is the August 3rd high. Exactly anticipating the move is very difficult. I mean, exactly anticipating the highs, intraday highs is very difficult. But in case the wage growth figure is horribly weak, one thing is almost sure that pound would end above 1.3315 levels. And once we have a day end close, as I said earlier, above 1.3315, doors would be open for a test of 3641, which is 38.2% Fibonacci retracement. And it is usually observed that a currency pair or a scrape or a commodity, usually I've observed in currency markets that when a 23.6% retracement is breached, the currency pair usually extends gains or extend losses to 38.2% levels. So, and on the other hand, if we have a if we have a very strong wage growth number and 180K, 160K or so kind of NFP figure, we could go down to 1.30, 120 levels or so. But the dips would still, still like to go long on dips, or at least I would avoid entering into positional short so long as I do not see a day end close below 1.3059. Once I have a day end close below 1.3059, I would prefer entering into positional shorts for a target of 1.2950, 1.2789 or so. So that's my take on GBP USD. Let's have a quick look at euro dollar pair, and the chart is a mess. I'm sorry for that. And the currency pair is trading around 1.1190. If you can see, 1.1193 is a 38.2% fib retracement, as well as 1.1196 is a 38.2% fib retracement. And quite interestingly, 1.1196 is also the 23.6% Fibonacci retracement of the massive fall from May 2014 to March 2015. So the area between 1.1190 and 1.12 is quite crucial. And let's go to dollar yen pair. It's in a falling channel, and we have had a sharp rebound from 100 levels. Go to TipTV's website and check a video titled, dollar yen pair, higher highs and higher lows for the first time in 2016. It's a good video. You can watch it later as well. Coming to this chart, as long as the falling channel is intact, the bullish move is good, but the conviction would come once the falling channel has been breached. And now, as we can see, there's just 1 minute left for the payrolls release. So let us just switch to tweet deck for that matter. Let's see if so that you get all the latest news pretty quickly over here, and the data must be out anytime. Payrolls 151K. It's not necessarily a bad number. As I said earlier, August has been August usually produces erratic numbers. So jobless rate holds at 4.9%, and it was expected to drop down to 4.8%. But don't go by the headline figure, because if the labor force participation rate has increased, then the stagnant jobless rate isn't really negative. It's a good news. You can also see US trade balance for July coming in at $39.5 billion, which is slightly narrower than the estimate of $41.1 billion. As we can see, Live Square tweeting non-farm payrolls 151K, estimated 180K, and previous I guess has been revised higher to 275K. So that takes away a little bit of heat. That takes a little bit of heat away from the current month of figure. Private payrolls are at 126K, 180K expected, and most important piece of data, miss on the early earnings, and that's a bad number. So the net result should be, I guess, dollar weakness. Let's just check out the initial market reaction. Yes, dollar yen pair is moving down, and if we switch to euro dollar pair, it has spiked at 1.1213. It clocked a high of 1.1252, which is pretty close to 1.1259, which is the 23.6% retracement level of the move from post-Brexit low to August 18 high of 1.1366. So let's just check out what's pound doing, and it's surprising that British pound is still stuck at 1.3315, which we a few minutes back we noted it as a strong resistance, and this is not a good news for pound bulls. Ideally, given the background of a strong manufacturing PMI data released earlier this week, pound should have blasted higher. At least it should have been at around 1.3350, but it's pretty much it's just stuck at 1.3315. So no, it's really underperforming in my opinion. And let's just switch back to the tweet deck. Let's see if there's some more insights available right now. $180 jobs had been expected. July revised up to 275K. Average hourly earnings up 2.4%. Need to check on the calendar. Let's see if we have something. So average hourly earnings has pretty much missed the estimates, and that's not the good news. This is the gold chart, and on the gold chart, if we can, as we can clearly see, the rising trend line. It's a sort of a flag and pole type of formation, and we also have a small falling channel formation over here. And given the weak data, gold is rallying right now, and in a sustained dollar weakness, it could extend to 1.1346 level, which is the channel resistance. Break above that would expose area around 1355. We would definitely want to have a look at what the treasury yields are doing, because that would offer more clues regarding the price action in gold. The 2-year yield is down 3.6 basis points. 5-year yield is down 3.3 basis points. 10-year yield is down almost 2 basis points. 30-year yield is down. 30-year yield is almost flat. So the yield curve is steepening again, following Yellen's remarks last Friday about the rate hike. The yield curve had steepened, and it was the steepest since 2007 as of yesterday. And the sharp drop in the short duration treasury yields bodes well for the yellow metal. So expected to maybe test around $13.40, $13.45 by the day's end. Let's so as we can see, pound has finally breached 1.3315 levels. The key idea here is that it needs to see a day end close about 3315. In the recent past, we saw a day end close about 3315 on July 14th, then August 2nd of August, and on both the occasions, it was met with fresh selling. So at least if you are a risk averse trader, you need to see at least 2 consecutive day end closes above 1.3315. And GBP JPY cross, which was one of the major gainer yesterday, is now stalled simply because the gains in British pound have been matched by gains in yen as well. dollar in pair, it's losing height, and as long as it's above 102.65, it's there is every possibility that we would have a rebound. Gold has clocked a high of 1330, and now it's uh, flirting with $13.25 levels. Two-year Treasury yield now down 3.6 basis points. Overall, I guess this report should squash hopes of September Fed rate hike. It's a different story, as I said earlier that the Fed is way behind the curve, as many London City experts say, and you could go and check on the Tip TV website. There are enough recent videos where guests have repeatedly said that Fed is way behind the curve, and now it's actually at the mercy of the market. So it's, and given that we are just a couple of months ahead, given that US elections are just a couple of months ahead, it is highly unlikely that Fed would shock markets right now. So, and now that especially we have had a dismal wage growth number, uh, that should kill the speculation of September move. Let's have a look at the commodity dollars. Australian dollar making a go, having a go at the trendline resistance. Rising trend line drawn from May 30th low to and July 27th low, and the pair is currently attempting a break above the same. The resistance comes around 0.76 handle. The day end close above the trend line would open doors for a further corrective move to 0.7655, 0.7690 levels or so. However, we need to see a day end close, as I said. Rejection at the trend line followed by a drop on Monday, negative closing on Monday and Tuesday would reinforce bears and could actually lead to a break below this week's low of 0.7490. A larger rising trend line drawn from Jan 20th low and May 30th low comes around 0.7400. Let's have a look at the Kiwi dollar and ZD USD. Pretty much same story, but slightly more attractive than Australian dollar, simply because RBNZ's Wheeler was on the wires last week, I guess, and he said that there is no need for rapid monetary policy easing. Kiwi already is the highest yielding currency among the majors, and the comments from Wheelers aren't helping the matter either. So compared to Aussie dollar, it's looking attractive on the charts, and that indirectly means that AUD and ZD pair should go down, and any upticks on AUD and ZD are likely to be met with fresh offers. Let's take a look at the dollar CAD pair, and it's retreating as well. Uh, what I've done here is I've plotted Fibonacci expansion levels, and the 61.8% Fib expansion comes around 1.3114. And if we see, we have two consecutive doji candles with higher upper shadows, which was a clear signal that the pair is due for a fall, and that's what we are seeing today. Once again, the pair could go down to 1.2980 levels, which is the rising trendline support. Let's take a look at the Euro GBP cross. Nothing much happening right now on charts. It's just losing height. And let me go back to pound As I said, the key idea, again, I would repeat myself, the key idea here is that 1.3315 should be breached on daily closing basis. Otherwise, I personally wouldn't be in favor of entering long trades. Let's have a look once more at dollar yen. Dollar yen has rather given up its gains now, and so that forces me to have a look at the treasury yields. Let's see what they are doing. And yes, the treasury yields are slowly recovering losses. It's still lower. The 2-year yield is still 3.6 basis points down. It was around 4.5 basis points down a few minutes earlier, and the same is the case with the 5-year yield and 10-year yield. And that also means that gold should have, gold should have, the bullish momentum should have stalled, and yes, it has. It's still hovering around 1326 levels. And if we put the major moving averages, so we have gold currently trading above the 5 DMA and 10 DMA average. The this chart, what this chart tells me is that the area around 1300 is now has become even more strong resistance. We also have I suppose 100-day moving average around 1297. So anybody interested in shorting the metal, I guess they need to wait for a day and close below 100 DMA, and that would open doors for sharp losses. And as of now, as I said earlier, I would prefer to go long. The upside appears restricted around $13.46, and a major bullish break would happen if the prices see a day and close about $13.56, which would be a case of a bullish break from the flag and pole formation. And flag and pole formation is a continuation pattern, which means the larger uptrend, uh, the bullish break then would mean the larger uptrend has resumed, and we could then go above $1400 levels. Just one last look at some of the major markets. Treasury yields, again, 2-year treasury yields, it's recovering now. It's down just 3.2 basis points. Keep an eye on the 2-year treasury yield, as that would give a more clear picture of how the markets are trading. If the 2-year treasury yield ends up flat or surprisingly on a positive note today, that would mean that probably would mean that markets are expecting upward revision to the NFP figure next month. And you know markets are still fearful that rates may rise this year. That would be a signal from the 2-year treasury yield if it ends on a positive note or a flat note. Gold is up at 1329. Dollar yen pair has recovered its losses. Good news for yen bears. Another good news for yen bears is that the long duration Japanese government bond yields spiked to near 6-month highs yesterday. And as we have repeatedly said on the Dirty Economics website, that yen is inversely related to the Japanese government bond yields. That is, higher yields would weaken yen and vice versa. This is because the nation is highly indebted, and sharp spike in yields would obviously result in a fiscal crisis. So watch Japanese government bond yields as well. There's a speculation that Bank of Japan would trim its purchases of ultra long government bonds, and that is sending the yields higher. The probability is that the pair would close above 102.65, and that should keep the hopes of a spike to 104.13 alive. Once the falling trend line resistance is breached, it would mark a sort of a major trend reversal. Interestingly, on the monthly chart, we have a bullish hammer following a sell-off from 125, and that is a bullish pattern as well. We can also call it as the previous two candles sort of these two candles are sort of a tweezer bottom, and that is also a bullish formation. So overall, I expect dollar yen pair to go up to around 106.645. So that's it for the today's coverage of the non-farm payrolls, and I shall see you next time. Thank you.